We're going to get started real soon, everyone. Welcome to everyone that's here. All right. Bibi, I think I made you a host. Okay. Welcome everyone to the Asset Management Monday series. My name is Ify. This is run by me and Bibi. My camera is off, and I probably am not going to stay for the entirety of the presentation, but thank you guys for coming. Bibi, are you okay if I hand it over to you? All right, thank you.
Thank you so much, Ify is down with COVID, so it took her a lot to just come on the call. Ify, we wish you quick recovery. Okay, guys, I'm not used to starting up this event, so just bear with me. My name is Bibi Ofiri, and we do this together, myself and Ify. We are sponsors and asset management on different deals. We've edited on some of our deals, and we are currently on a deal. We're currently on a deal right now and all that. And one of the reasons why we are doing this is to encourage people that this is actually possible. If I don't know if we're recording this, okay, is to encourage people that this is actually possible. And the more education you have, the easier the entire process becomes and all that. So education is very, very critical. And that is why we are doing this. So I'm going to go right into what we have today. And what we have is understanding different exit strategy in multifamily. One of the reasons why we are discussing this is because some people believe that exit strategy starts from maybe the year you want to sell or the year you want to refinance. There's a saying, and I keep saying it, and I will not stop saying it. You make money when you buy, not when you sell. So there's a critical role in there's a critical aspect in the acquisition for you to exit. That is why you are seeing so many issues or so many problems happening because of the way the property was bought. So exit strategy starts from the beginning, and we're going to quickly dive into the acquisition part before I move towards the different exit strategies you should take depending on what you're going through or depending on your situation. We have different exit strategies, and I'm going to explain them shortly. Please allow me to share my screen. I think it's the first time I'm sharing my screen on this event. So guys, bear with me on this one. Okay, can you see my screen? Okay, so today we'll be focusing on the importance of strategic acquisition, exit strategy planning, and due diligence preparation. I'm going to run through the first one, importance of strategic acquisition. You make money when you buy and not when you're selling. And the reason is because when you are purchasing, you have to follow some purchase price terms. That means you have to buy below the market value. So many things are happening. I know some of you are hearing the news that some properties are going underwater. They are foreclosing, and some of you are limited partner investors, and you've lost money. And the sole reason is because of the way the property was bought, either because of the financing terms or the way it was bought in terms of value. Maybe it was overpriced. And we saw that happening in 2021, 2022. and 2020, part of 2023, because one, interest rate was low, and that was a seller's market. Sellers were raising their prices to God knows when, to God knows where, and all that. So we saw those things happening. So if you buy an overpriced property, you pay the price while exiting. There's really there might not be any way for you to just get out of it and for you to sell. And you might end up selling and you will sell below what you bought it. And that's what we are seeing right now. I am currently on a limited partner deal. In one deal, I decided to invest in. And I did that investment for just a different reason, which I can't disclose yet. It was just for a personal reason. That's why I invested in that deal. And in that deal, the property was overpriced, and they're selling now. And they bought the deal for somewhere around 15 million, and right now they're selling for 10 million. So invariably, the entire investor's equity is gone and all that. So that's what we are trying to avoid. And that is the reason why the acquisition part of it is very, very important. So you have to pay attention to how much you're buying, the favorable financing. We also saw people using bridge loan. There's nothing wrong with bridge loan, don't get me wrong, but you have to understand the market at the time you're taking up a bridge debt. It's very important for you to understand it before you do that, because in 2022, if interest rate was 0 and you're taking a bridge rate, is there anything lower than zero rate? You should know that interest rate will go high, and that will affect your exit. Or if you've not planned towards your exit, in the sense that, okay, my exit might be 5% and all that, which nobody envisaged, because we didn't see interest. Nobody has seen interest rates going as high as the way it is, the way the Fed decided to increase the interest rate and all that. So you have to consider critically your financing before you go in. There are different financing terms for different deals. So you have to take that into cognizance. Not because you want to do a deal, you jump onto the first terms you have. And the next thing is the value add. What is the business plan? What value are you adding on the property? If there is no form of value or any form of business plan, then why are you buying the property? Value add is not just renovation. Value add can mean so many things. It can mean that you are bringing in a better property management on that property and giving them better customer service. It can mean that you are introducing some amenities. You are introducing some things on the property that will give that property better value, things that can make that property appreciate. It does not necessarily mean it's just for you to renovate inside the unit and that's it. No, value add is many things. The bottom line is for your tenants to be happy, for you to meet their needs, and you are providing value to them and they're happy. Another very important thing in your acquisition stage is your due diligence. That is very critical. Our due diligence stage is very critical. I'm releasing a video tomorrow, and it's a step-by-step live due diligence that I conducted. And in that, you will see so many things, questions that were asked and all that. Due diligence is an intensive process. So it's something you should do, because these properties are not cheap. So you should spend time to do it. Then the next one is cash flow. Cash flow. If a property is not cash flow, it doesn't give you positive cash flow, I really don't know why you want to even do it in the first instance. And if you know you cannot, you can't manage the expenses, then there is no reason why you should buy it. I'm seeing so many people getting on deals mainly because they want to be GPs or they want to own a house. You don't get on deals because you want to be a GP or because you want to own a house. If that deal does not meet the needs, or is not cash flowing, or it does not even have the ability to appreciate, and first of all, you're already carrying a liability, you should start thinking of bringing an out-of-pocket checks to pay up some bills, because you didn't do your due diligence. So if you don't have this at the beginning, then there's already a problem for you to exit. Remember, your NOI is very, very important in exiting. So if that is affected, then there's trouble. Then the last thing is your market conditions. You need to buy during a buyer's time. And all these things are very important for your exit. When you're buying a property, when is the buyer's time? Buyer's time means is the people that want to buy, they're the ones that gives the terms, they're the ones that will give the conditions or give their pricing and the seller will take. So that is the buyer's period. You're looking for that period, and that period is right now. Periods for buyers, yes, we've not gotten to that 100% where sellers are becoming very flexible, but we are seeing it losing up than before. So you need to also look at the buyer's condition. So now let's dive deep into the next is what exit strategies are available. Is it just to sell? In short, what are exit strategies? Exit strategies are strategies for you to come out of something or for you to get out of a deal and all that, considering what I'm talking about. Then exit strategy should be clear from the beginning. Never lose sight of the business plan. So, like I said, all these things are from the beginning. The business plan is from the beginning. So when you are exiting, that is the picture of what you're looking for. What is the plan? Maybe your plan was, I'm going to exit in 5 years. So when you are exiting, you are planning towards the 5-year goal. Our next episode, I'm going to break it down in terms of numbers, and when you're doing your underwriting, how you can factor in your exit strategy from day 1 to day 5, to year 5. Because there are numbers you should be looking at. If you want to exit at 1.5 million, that means that from day 1 or year 1 of your business, of your deal, you need to start improving that property that will make it. Let's assume the property, you bought it and the NOI was $800,000. And you said, in my exit in 5 years, I want this property to be 1.5. So you need to figure out a way that you can bridge the gap and get it to that 1.5 value. So that is what we are looking at here. So that is the exit strategy. So there are different exit strategies for different purposes. So I'm going to start with the first one, which is sales. I'll be discussing 6 exit strategies. Sorry, I have cold. So I'll be discussing 6 exit strategies in this section. And based on your circumstances, you can choose whatever one that appeals to you. The first one is sales. That is selling the property to another investor or investor group. The advantage of this is that you can quickly sell and you can become liquid. That means you have cash to do whatever you want to do. But there are some factors you need to consider. The first one is the market condition. So when you are selling, you want to also look at the interest rate at the time of sale, because you're selling, that means there's going to be a buyer. The buyer is going to look at the interest, meaning that is how he's going to get his loan. The bank is going to consider the interest rate at that point. They're also going to consider the market cap rate, because to a large extent, interest rate affects the cap rate of that property. So you want to check out the property. If the interest rate is not really too good, or the cap rate is high, then that means your property is losing value. So let me explain again. When a cap rate is high, that means the value of the property is lower. When a cap rate is low, then that means the value of the property is higher. So for example, I have a property and it's 8% cap. That means the value of that property is low, is small. But when I have a property and the cap rate is 3%, that means that property is very, very valuable at that point. So these are things you want to look at: the market condition, the property valuation. So I just mentioned that briefly. This will determine how much you will sell your property. The property valuation is important. So if you go back to what I was saying about acquisition, you understand that the valuation of the property, the NOI, the net operating income of your property, plays a large factor in the valuation of your property. The cap rate plays a big factor in the valuation of your property. The interest rate plays a large role in the valuation of your property. And the DSCR, which is debt service coverage ratio, it plays a very large evaluation on your property. So these are things you need to consider. So you can't just wake up one morning and just say, I want to sell, without considering these factors. Then potential capital gain taxes. you want to avoid paying Uncle Sam large amount of money. But like I said, it depends on what you're going through. That will determine if you need to sell without doing other strategy. The next for me is a refinancing. So the refinancing is replacing the existing mortgage with a new loan. So you're not selling, but you're just paying off the previous loan and getting a new loan on it. That is what you're doing in this case, often to take advantage of better terms or to pull out equity. The advantages of this is the maintained ownership while assessing capital, potential for improved cash flow with better loan terms. So if I'm refinancing, that means I must have improved my property, or maybe there's a better loan terms. Like some of us that have a loan amount of, let's say, 7% on our property. Let's say in the next 3 years or 4 years, interest rate goes down to 4%. That is the best time to refinance because the interest rate has gone down. And again, it might also give you an opportunity to also cash out on the equity. You can refinance without cashing out of it, the equity. So it depends on you. You might decide to leave it on it, but I see no reason why you want to leave equity on a property that's made that money. The best is for you to pull it out and keep on performing on your property. So one thing you need to consider is your loan term. So for example, like people that bought in 2022, let's say they bought at 3%, and now you're trying to exit. Now you're trying to exit and you're exiting at 7%. That is a jump of 4%, and that can kill your cash flow. It's possible that when you are 3%, your property was cash flowing. But when you decided to refinance at 7%, your property might not even cash flow. So that is a wrong approach in refinancing. You want to take note of that. You want to refinance when the interest rate is low, and when and exit when you want to refinance when your interest rate is high and exit when it's low. That's what you really want to do at that time. So the loan terms, you also want to consider the loan terms. What are the loan terms around it? The qualification requirements. Do you have the qualification to refinance that property? Because the lender, depending on the lender, can come up with different requirements. So for example, if you have a bank loan, let's say you currently have a bank loan. A bank loan, you necessarily don't need any experience for you to get a loan from a bank. But let's assume you are refinancing from bank to an agency loan, let's say to a Fannie or to a Freddie. It will require that you have experience with their loan. So that might change things for you. You might need to pair up with someone that has a Fannie or Freddie loan and all that. So the requirement might change at that point. So these are things you want to reconsider at that point. They might give you some waivers on some things, maybe because you've managed the property for a long time and all that, but it's just Fannie Mae and Freddie, they have their specifications. So you need to find out from your lender what that is at that time. So these are things you need to consider when you are refinancing. The next exit strategy is it's 1031 exchange and condo conversion. So I'm going to start with the 1031 exchange. In this one, you are selling a property and reinvesting it with a like-kind property. So you can decide that I want to sell my single family property and buy maybe a 4+ or a 5 units. That is a 1031 exchange strategy. Or I want to sell my 20 units and get a 50 unit at an exchange for that. The advantage of this is that you are deferring capital, an opportunity for you to upgrade to a higher valuable property. You know, you definitely are not selling a low property to buy a lower one. Definitely you're selling. The rules of 1031 exchange is that the same number, or I think I might be wrong, but I think you can exchange it with equal or greater value, maybe double. I can't remember the exact thing. You can go verify that. But the idea is that you're exchanging it for higher value property. Then consideration, things you need to consider is street, timeline, and rules. I felt if I was a victim of this in 2023, we didn't meet the timeline because we also want to buy a property that, because we're in a rush, the property does not make sense, or the property is not cash flowing and all that. So we did a 1031 exchange. We sold the property in November last year. And we had 45 days to identify a property. Before we sold it, we've been looking for a property. We didn't see because of the way the economy was like last year. So it was difficult to get a deal that would pencil out. So we tried 45 days. We got to 45 days and we couldn't meet up and all that. So that was how we fell off our 1031 exchange. So these are things you want to avoid. But the reason why it's okay for us is because we have K1s that can write it off. So no problem. But if you're in that situation that you are doing a 1031 exchange, you need to pay attention to the timelines. It's very important. And you need to have a suitable replacement. You don't just want to buy any property because you are because of the street timeline. You don't want to do that. Another exit strategy that you can navigate is condo conversion. So this is how this works. For example, let's say you have 100 units. You can decide that you bought the property as one building, maybe a one portfolio and all that. You can decide I want to exit by selling them one by one. I don't want to sell them as a whole portfolio. That is another exit strategy you can take up. So you can decide to sell those things as condos individually. And not just that, you can also decide to create an HOA on it and still manage the property even after you sold it to individuals. So this is an exit strategy. I tried to do it 3 years ago, but I didn't go ahead with it because the seller did not agree to my price and all that. But this is an option that you can take in exiting. So it's not just refinancing and sales. I think we've limited our minds to that, but there are other options that we can follow. Advantages of this is the advantages of this is that potentially higher total sales price. Definitely when you are selling things in bits and pieces, the ability for you to gain more money is high because let's say it's $10,000, you're selling each for 2,000. I mean, you're selling each of them 10 units for 2,000. That means you might even get double for the amount. So the ability to have an increased higher total sales price is high. You can diversify your buyer's pool. That means you can have maybe an investor buy one, you can have a family people buy one, you can have students buy one, you can have investors from different states buy. So different buyer pool, you can have them all buying your property. Things you need to consider, very, very important on this one, legal and regulatory hurdles. This is the #1 issues because you need to even, when you're buying a multifamily of this kind and you're thinking of converting it to condo, there are regulations in that state and in that county that you need to follow. It must follow those. Sometimes you might not be able to do it. So you need to consult with the local and find out if you can actually make this a condominium and what are the rules and hurdles you need to follow. It's not a straightforward process, but I know that there's some legal things around it. Then the market demand for condos, you need to know your market. So for an apartment that is close to the beach or close to vacation areas where people would like to vacate, this might be a very good exit strategy for you because some people just want a second home close to where they do their summer breaks or vacations and all that. So this might be a good exit strategy at that point for you to consider doing. But if you're in a busy place, a different type of area, this might not be a good strategy because not everybody likes condo, and that is mainly because of the HOA fee. I don't like condo because I get to pay HOA. I don't want to pay anybody extra money. It's like I'm paying another rent or another mortgage and all that. So these are things you need to consider. There's significant upfront costs. There's some monies that you use to do this condominium, convert it into condominium. So you need to take that into cognizance that you'll be spending some money down the line and all that. So when do you consider whether to sell, refinance, or do a 1031 exchange? So for you to sell, when to consider selling is when the market condition is favorable. Right now, we are not in that time where the market condition is not yet there. So this might not be a good time for you to sell. This is my own opinion. So it's up to you if you want to sell now. Also, if you need liquidity, you want money maybe to do other things, this might be a good time for you to sell and become liquid and use that money, divert that money to do what you need to do. Then when a property is underperforming, is not doing what it's supposed to do, might just be the right time for you to sell. Or the property has maximized its potential. That is, you've built a lot of equity, you've done everything you need to do on it, you've executed your business plan. There's nothing else to be done. Or whatever needs to be done is very minute, might not give you a significant return. That might be a good time for you to sell and all that. So on the deal we are currently on, the seller has held on, has refinanced from this deal 3 times and is now selling because he has maximized everything he needs to maximize at that time based on what he bought it for. So it's the right time for him to sell. So that is what you should consider when you're selling. For refinancing, when the interest rate is low, that should be a good time for you to consider refinancing. Like right now, most of us, our interest rate is around 5, 6, 7. Maybe in a year or two, the interest rate might fall to maybe 5. That might be a good time for you to say, okay, I've improved the value of this property. I think it's time for me to sell so that I can reduce my interest and make the property cash flow better and all that. And when you notice that you've increased the NOI, so for example, you bought the property, maybe you got there and the rent was, let's say 500, and within the space of 2 years, you've improved the rent to like $200. You've improved the rent to $200. That means you've added value on each unit of 1,500. That is significant improvement. And if you were also able to work on your expenses, that means your NOI should be great. So for example, if your NOI was, let's say you started with your NOI was 500 and you improved the property and the NOI is now 3 million or 2.5 million, that is a significant, in short, you've really, really improved on that property. And that might be a good time for you to assess the equity on that property. So this thing for refinancing is going to be determined on the value you've put on that property, how much equity you've built in on it. And if you also want to improve your cash flow, that is where the interest rate comes in. So if you refinance to a better rate, your cash flow might be better. Or let's assume you have a primary loan and a secondary loan. And let's say your primary loan is 4% or 3% and your secondary loan is 7%. You might want to consolidate the both of them to one single interest rate to get a better terms. So this might be one of the reasons why you want to refinance. Then when do you consider a 1031 exchange? Is if you want to defer taxes. Let's say the property has accumulated a lot of, like this Pops and Mars, most of them bought their properties many years ago. They've had these properties for 20 years. They've had this property for 10 years. Some people 30 years. I've seen properties that people have owned for 30 years. You can imagine especially they were really operating those properties very well. You can imagine the amount of equity that they've accrued on it. So just selling it might not be a good thing for them to do. So they might just want to do a 1031 exchange to defer taxes and also maybe to diversify their portfolio. Maybe they had a 20 unit, like I mentioned, they might want to buy 100 units this time around. So that might be the reason why you want to do a 1031 exchange. Then upgrade your real estate holdings. It's possible you had C class and you want to upgrade it to A class. So this might be one of the things you should consider. Sorry. So some other exit strategies that some of us don't even know about that we can take advantage of. I know some of us are surprised. Oh, I thought it was only refinancing and selling. No, there are other ways you can get out of a deal. So you can decide to buy out your partnership. This is one I like it and I don't like it. I like it because I like it when let's say your partners are ready to, they are done with the deal, and you know that the deal has potential, you can decide to buy them out and own it yourself and all that. So that might be when you want to consider this. So let's dive into this a little bit more. When do you consider partnership buyout? Selling your share of the property to a partner or bringing new partners to buy out existing shares. The advantage of this is that it provides liquidity without a full property sale. That means I can get access to, I can sell my shares to whoever without them selling the property. So they will pay me, they'll pay me in exchange. I mean, they'll take my share in exchange of money. So I'll get the money and they'll take my share. So that's a way I can exit if they don't want to sell the property. Then potential for strategic partnership. Peradventure, you have issues with your partners. Let's say you and your partners are in loggerhead. These things happen. I've seen properties that I've tried to buy from two partners or three partners that are fighting amongst themselves. They can't even stand each other. They want to get out of it. They just want to sell. If one of the partner is liquid, has a lot of money, it can decide that I don't want to sell this property. Rather, I will pay you guys to go out rather than selling it. But the reason why you find some people not doing that is because it can be very expensive. And again, the value might be very confusing in the sense that the value of this property might be 2 million, but because it's between us, I might say it's 1.5. And that might cause some litigation issues. And before you know, we'll find ourselves in court. So this can be kind of rough if not properly managed. But it's a way for you to exit when you have very demanding partners or partners that want to go out, or you're already tired of it, you want to exit. You can go this route of buying, they should buy you out or you buy them out, one of them and all that. But it's expensive, so you know. Consideration, valuation of shares. So valuation of shares is a very important factor. Alignment of interest with new partners. So the new people you're bringing on board to exchange the old ones out from, they must align with your goal. If not, you keep going around the same circle and you end up buying them out again as well. Legal implications. So I told you, you guys might find yourself in court if you guys are not matured enough to handle this properly. So it's an exit strategy, but it's not for everyone. Another very interesting one that I love very much, and we are seeing it happening on a regular, is redevelopment or repositioning. We are seeing a lot of hotels becoming multi-families. We are seeing what they call it, family adult living homes. I've forgotten the name. Senior living homes. We are seeing them they are converting them to multifamily and all that. Things like this happen. So you can decide to exit in a different way by repositioning a property. Let's say the property was initially an hotel, and maybe the hotel is not performing well. You decide to, okay, I want to reposition this to multifamily. We are seeing that happening a lot. Many people are converting hotels to multifamily, and that is how they're exiting from that and all that. So advantage of this is potential higher rent and property value. When you convert an hotel to a multifamily and you're pretty well, the probability that it becomes better is high. Modernizing the assets, because you have to pump in some money to make it look more modern, is going to make the property look a lot better than the current stage. We currently did this for our property. We took up an A-class student housing, and we repositioned 50% of it because of the demand. These things, you practically do repositioning, especially when the demand of the area is changing. So I'm going to talk more about it in the next slide. But things you need to consider is capital expenditure requirement. It's expensive. So if you're converting an hotel to a multifamily, remember you're going to introduce kitchen, you're going to introduce make it very comfortable, like the way a residential will look like and all that. So that might cost you a lot. We're also seeing people converting office buildings to residential. I do not encourage that, but people are doing it. So it's going to cost you a lot of money. Sometimes even the value of the property it might not even make sense. So those are things you need to consider. If I'm repositioning it, is it better if I sell it and that's it, or it will give me more value if I do that? Then project management, who is going to be managing the project for you? You need to take that into consideration. If not, this project can linger for maybe many years and you end up spending so much money. Market demand of new positioning. So if you are converting the hotel to residential, why are you doing it? Is it because the demography has changed? You have more residential people than visitors, than tourists in that area? Why are you doing it? Why reposition? What's the opportunity? Is it that because people are repositioning office spaces right now because of the market, the economic condition. People are working from home, and we are seeing that offices are now empty, and people are looking for places to stay. So that might be a reason. Okay, people are looking for houses to stay rather than working in an office. I might decide to reposition at that point. So these are things you need to consider before you take before you take up such decision. So when to consider buyout, repositioning, or seller financing? Okay, I think I've not discussed the last one. So this is another exit strategy, seller financing. I see a lot of pops and mas doing this because they own a lot of equity on it. They just prefer to just carry some and still be making monthly cash flow from it. So seller financing, by financing the sales for the buyer. Advantages of this is that it will attract a lot of buyers. Sellers that open up their houses for seller financing, you will get more buyers than any other person that is going to the bank. Just be rest assured. The potential to sell higher is high. You can decide that the property is worth 15 million. I want to sell mine for 17 million and give them at a good rate. The probability you can do that for seller financing, owner financing is very high. Ongoing income from loan payment. So for the seller, you can get income from the loan payment because they'll be giving you money maybe on a monthly basis. You'll be making money still. You've exited from it, but you're still making money from the property you've exited from. So this is I love it. It's very good if you have a lot of equity and all that. Then things you need to consider. This is the disadvantage of this, the risk of buyer's default. So due diligence is very important in this part. The buyer's credit worthiness. You don't want to just give this opportunity to anybody, because once they default, that might be a problem for you. So you want to do your due diligence on the buyer's credit worthiness. You might need to even get a third party to handle that. Handle the management for the loan servicing for both of you and all that. Management of loan servicing, you might not want to handle it yourself. You might need to involve a third party to do that. Then risk of buyer's defaults. This is one of the major challenges for seller finance. It's very good. I encourage it. I like it, but these are just the pitfalls to it. When should you consider buyout? When should you consider repositioning, seller finance? Buyout is when you're seeking full control. If you want full control of a property, you can decide, call your partners and say, guys, I'm going to pay you off. I want this property. You should be ready to pay a lot of money. So then when you have a misalignment of goals, like I said earlier, or when you're having a lot of conflict, and it's becoming a major issue, this might be something for you to consider. Either you buy them out or they buy you out. One of them, you might need to consider that. Or there's potential for significant future profit. So for example, if your partners want to sell the property right now, and you know that this is not the best decision, but they don't want to listen to me, they want out, you might decide that, okay, fine, you guys want to sell, no problem, I'll pay you off and I'll hold on to the property. Because I believe in the next 3 years this property is going to be double and all that. You can decide to do that. That's when you can consider doing this. Then repositioning the property. When do you want to do this? If the market has changed. So this is the job of an asset manager. So if you need to continuously study the market Are people going in? Are we having more people coming? Is there migration, or people are leaving? Are businesses leaving? What is going on? The market will determine if there's a significant, like for us, we bought a student housing and we saw that the student portion of it was decreasing. The market was changing. You know, now many people are not considering going to school any longer. So that played a factor to that. So students are now not going to school, so it's affecting that portfolio. So, but before we bought it, we did a due diligence. We knew that was going to happen. We already stated from day one we're going to transition it and all that. So, and we also saw the opportunity that more family-like people were coming in. So these are market research that you need to do, and that will tell you, I think I need to quickly reposition this property to meet the future need of this environment. And when the property is underperforming, let's say you have an hotel, like what I said, the hotel is not performing, you might decide to transform or reposition it to a residential and make money, steady cash flow and all that. Or you're doing an Airbnb and it's not performing, you might decide, okay, I'm renting it long term and all that. So these are things you might decide to do. Or there is a strong value add opportunity. So if you decide that, oh, hotel is no more the reigning, it's not going to give me as much money as residential, I might decide to reposition. So these are reasons why you want to consider that. The seller finance, if you want to attract so many buyers, you want the competition to be so much, and you want to maximize the sale of your property, because the more buyers you have, the more you can do best and finance and give them the premium price for your property. If that's what you want to achieve, premium price, you might want to go that route. Achieve a higher sales price, that is it, or create a steady income stream. So this is for people, I would advise this for people that are senior citizens. Let's say you are 80 and you do not trust that your kids can handle your assets or portfolio. You might want to set it up in this way that they will get steady income on a monthly basis. Money will keep coming from that asset because you are doing a seller finance and all that. So this might be a strategy if you are elderly, or you maybe your kids are not interested in managing your assets. It might be something you want to consider to take care of them in the future and all that. So this is my last slide. So before you exit, what are the due diligence preparations that you need to do? As an asset manager, you need to start developing strategies. I'll repeat it again. You make money when you buy, not when you sell. So there are some things you need to be doing. You need to have improved the property, curb appeal, the front, the area, the property. If you want to paint, you need to start painting. If you want to start doing some value add renovation, in the sense that maybe you might decide to do 10, maybe you have 100 units, you might decide, okay, I want to do a sample with 10 units, so that if I renovate those 10 units, let me see if I can increase rent. You might decide to push up the rent, and that might be your selling price for the next buyer. So these are things you want to do to show the buyer that you're buying a value add property, because I did this with 10 units and you can achieve this with the remaining 90. So these are things you want to consider and all that do. So these are preparations you should have been making, not when you just want to sell, you start doing all the repairs and all that. And don't forget, this thing might affect your profit and loss, because you might have to engage some contractors to do this, and they might not be maybe they might not be capex repairs, because if they're capex repairs, they go under the line. But let's assume they are normal operating repairs, you end up spending a lot of money. So there are things you should have started doing way before you sell. So selling a property starts from year one. If you want to sell in year 5, start the preparation from year 1. Then you consult a mortgage broker, because you also want to know the perspective of a lender. You want to know what the lender will quote for your property, so that you know what your buyer can get in terms of debt from it. So you want to also put yourself in the position of a buyer, someone that is buying. How much debt can he get from it? So you want to consult a broker. So when you consult a broker and they say, your property is worth this amount, this is the loan amount I can give to you. But if you're able to increase your NOI to this, I should be able to give you this. So based on that information that you have, you might decide, okay, my NOI is 900, and the lender is saying if I push it to 1 million, I will get this loan debt. So maybe I need 5 more months or 6 more months to do this. So you work 6 more months, maybe you start pushing up your rent for your unit, start pushing them up so that your NOI, and deliberately start reducing your expenses. All these are in preparation to sell your property. Things to consider: your CapEx project, your value add project, your curb appeal, timing of repairs in preparation for a refi event. You want to do these things before the year you want to, because these things can affect your numbers. You don't want anything that's going to affect your profit and loss. So I will end by saying this again: you make money when you buy and not when you sell. So I don't know if anybody has any question. I think I was able to break down different exit strategies that you can embark on in your multifamily. You can even use this for your single family if you are still in that part of real estate. But for us here, we are in the multifamily space. So these are strategies that you can embark on to continue your journey. Does anybody have any question? Oh, I think I was clear enough. You have the replay. It's going to be, hey Masha, good to see you. The replay will be on the Multifamily Freedom Chasers YouTube page. You get to see it there, and you also get to see it on my page, the Blue Ocean Multifamily Group page as well. Okay, let me read the information. Need to drop. This is great info. Thank you. Okay, I guess that is all. I can't see any question. If you do, you can raise up your hand. I will mute you and you can ask your questions. Okay, I guess that's all for today. Ify, please, we wish you quick recovery. And thank you everyone for coming. Please have a wonderful day.
Thank you. I wish you and Ify a speedy recovery.
Thank you. You noticed I have flu as well. It's been tough. So we decided that we must do this. Thank you all and good night.
Thank you.
Thank you.
Thank
Yeah,
you.
good night. Yeah, bye.
I thank you.